All right. Good afternoon, everybody. Welcome to our options inventory trading today. My name, of course, is David Settle. Today is December the 9th, 2020. Glad to have everybody here today. We're down a smidge, just a smidge on the markets today. No, I did not go on vacation. I did not go on vacation there. So everything is okay here. So with that being said, let's go down to, let's take a look at what's going on in this. Give me 1 second here. Where you guys at? There we go. There we are. All right. And let me move my chat window over. Isn't that amazing, Dennis, how market cap weighted indexes work? That's kind of what I've been trying to teach you all as well over the past, I don't know, however many long I've been bugging you about it. I bug you guys so much. I bug you guys so much about this concept that sometimes I feel like you get sick of me talking about it. But the idea is for a market cap weighted index, if there is a disparity in sector weightings, you can't have a bullish market with the smallest sectors in that disparity outpacing for an extended period of time. Short periods, sure. Extended period of times, nope. Nope, the bigger sectors are the ones that have to lead in those kind of rallies. And that's, today, I'm a little bit delayed. So what, the NASDAQ's down 2%. The S&P, I believe, is down like 1%, maybe, close to 1%. And this should put in context today, like, this is tanking. This is tanking. Right? Let me get my this is tanking. Right? This is tanking. This is tanking. Right? This obviously is tanking. Right? Because that led to more, right, over here. This one obviously didn't lead to a whole lot more. This led to the intermediate pullback that we were in. This pretty much finished the intermediate pullback. This is not tanking. Right? This isn't a huge sell-off in the least bit, unless we are over position sized. Then it's a tremendous sell-off. But as of right now, not a huge sell-off. So not a big concern. Yeah. Just anything in between here is just, relatively noise in this. Looks like it was a 0.88. So keep that in mind. Like, we don't get wrapped up in the language of people who are trying to sell advertising, because that's what they're doing, right? We just have to remember that that's what they're doing. They're just trying to sell advertising. So they want things that will get people to watch. And markets in turmoil gets people to watch. Market sell-off gets people to watch, right? And gets people to pay attention. And that's just not the case. Not the case here today. It's just a little bit of a decline and not out of the ordinary, nothing unexpected. We did break below yesterday's low. We still have this gap over here, which I still consider a common gap. We know that's going to get filled. We do have some support in this, I guess we don't know what's going to get filled, but there's a good chance it's going to get filled, this gap right here. There is some volume here, but below this volume, there's a volume gap. And so we can easily come down to the point of control. We'd be into the value area at that point. So, it's not that big of a deal. This is why, but it's also why I kind of mentioned, yesterday, this is also why I mentioned that I still want those negative deltas, right? Because of days like this, because of all the things I talked to you about the extreme bullish sentiment we have, we can take advantage of extreme bullish sentiment with bullish trades that have a specific time frame and still protect ourselves from the extreme bullish sentiment in case it turns around. And that's what we're doing. That's what we're doing here. Remember, we don't all, because of the beauty of options trading is those and for that matter, futures too, but any kind of leveraged market, the beauty of it is you can trade both sides very easily. It's a little bit more difficult than equities because you have to short the stock, but you can trade both sides pretty easily of the market, and you can trade both sides at the same time in leveraged markets because of the different time frames involved, because of expiration dates and different time frames. So you can and still succeed in your trading with trades on both sides of the market. In fact, an iron condor is basically trading both sides of the market at the same time, which we do a lot, right? So you can trade both sides of the market with different trades, different strategies, different time frames, and still succeed and not get caught. And so if there's anything you learn from me, from a directional options trading standpoint, I hope that is one of the biggest things you learn. Is in addition to the risk management element of it, so you don't take stupid losses, big losses, right? Which are stupid losses. A loss is a bad loss. A loss is not a bad loss. Because there's nothing you did wrong. That's always an issue, and I know I'm soapboxing it here, but whenever people say, like, if you're like, I remember a lot of my colleagues would say this, and it always just drove me nuts. But this idea of, okay, let's take a look at this trade, it didn't work, and let's see what you did wrong. Well, no. It's an odds-based trading. It's odds-based exercise, right? So there's not, if a trade goes against you, it's not because you did anything wrong. So it's a loss in and of itself is not a bad thing. A big loss is a bad thing, right? Because usually you did do something wrong. Usually we did either over position size or we stayed in the trade too long and didn't get out when we were supposed to, and take a small loss because, and that's the problem. That's the problem when you think that you do something wrong on your losing trades, right? When you think that you do something wrong on losing trades, then what that does is it encourages you to avoid closing out losing trades early when you're supposed to. Because you think you're doing something wrong, right? You think it's a wrong thing. So you don't get out early, you stay in it because you think, well, if I'm doing it right, it will turn around and work out. But then it doesn't, as we all know. I'm sure we have all experienced it. It doesn't turn out right. And then we end up creating this self-fulfilling prophecy because then we did do something wrong. Right? Then we do something wrong because what we did wrong is we didn't take the loss when we were supposed to. So taking a loss, having the mentality of taking a loss means we did something wrong, means that you don't take losses when you're supposed to because you don't want to do something wrong, and then you end up doing something wrong as a result. I know I'm kind of speaking in circles there, but I hope that makes sense because if you can't take a loss, then you're going to have a hard time trading in this derivatives type market. Okay? The halftime. So you just get out, you move on. You move on to another trade. It's just, you just move on. I coach basketball and I tell my kids that there are 60 possessions in an average high school game. 60 possessions. I tell them that, how important it is to not turn the ball over. So for those who don't know what that means, it means that when we get the ball, that we don't get a shot. We give the ball to the other team without ever getting a shot up. So the other team either steals it from us or we throw it out of bounds, whatever, and they don't. So I tell them that we have a goal, that how important it is to protect the ball, but we're going to have turnovers. Like I expect out of 60 possessions, we'll have potentially 12. That's kind of our goal. 12 possessions where we don't get a shot up. And so it's okay. If we have a turnover, it's okay. It's not a bad thing. If we have 20 turnovers, then we did something wrong, right? That's the learning experience. When you shoot, we expect that we'll shoot, for example, from the big 3-pointers, we expect that we'll shoot 40%, which means that, and we say, finish every shot, own every shot. Like, shoot every shot like you're going to make it, right? Finish every shot, own every shot. Those are the two things I really stress, as well as shoot on balance, shoot in rhythm. But finish every shot, own every shot. Those are two big things. As if you're going to make every shot you take. But you're going to miss 60, 65% of your shots from long distance. You're going to miss. So that means if you miss a shot, it's not a bad thing. You didn't do anything wrong. You didn't do anything wrong. Now, if we miss 75% of our shots, then we're doing something wrong. If we miss 80% of our shots, then we're doing something wrong. Either we're not getting good shots, or we're not shooting on balance, we're not shooting in rhythm, we're not owning our shot, all that. So with all that said, it's the same thing with trading. You're going to, if you trade 100 times, if you make 100 trades, full put spreads, iron condors, whatever, you're going to lose. Like, you're not going to have a 100% success rate. And if anything is marketed to you as something that has a, 80, 90, 100% success rate, then just know, number one, like I have a kid right now who's shooting 6 for 7 from 3, and through 3 games, he's shooting 6 for 7 from 3. He's one of my worst shooters I have, one of my most inconsistent shooters I have. But right now, through 3 games, he's shooting 6 for 7. So technically, we could market him as our best player that we've ever had, right? Shooting 6 for 7, like that, he's insane. It's our best trader, but he's only taken 7 shots. Once he gets to 100 shots, I highly doubt he's going to have made 94 or 95 or 96 or whatever. He's not going to have made that many shots. He's going to make 30 or 40. The averages will even themselves out. So number one, if something's marketed to you as a 80, 90% success rate, number one, there's not enough shots. There's not enough trades. It's a short time frame. It's a short number of trades that had a really good hot streak, right? That's normal. That's very typical. Or number two, if it is over a long period of time, then it's got a very, very low profit-loss ratio. A very, very low profit-loss ratio. Like, I'm risking $10, $15 to make one. Like, that's very, very low. Which means, remember, very low, very high probabilities also are associated with very high risk. Risking $10 to make one is a very high risk trade. It's a very high probability trade, but it's also a very high risk trade because you can't take a small loss on that trade. You can't get out if you're risking $10 to make one, you can't get out with a $1 loss because you'll get out way early. You'll still be way within the range of making money if you get out with a $1 loss. You can't even get out with a $5 loss because you'll get out way early. Right? You'll still be easily within range of getting max gain if you get out with a $5 loss. So the problem with those kinds of trades, the reason why they're high risk is you can't take small losses. You only, when you take losses, because nothing's 100%, you generally take huge losses. That's the nature of those kinds of trades. So with that being said, you're going to have losing trades. That's just the nature of the beast. And when you do have them, you're not doing anything wrong. Everything is fine. The only time you ever do anything wrong is when you have big losses. So to take it all the way back from where I started my soapbox, if you feel like you're losing a lot of money today, number one, we're either over position sized, or number two, which also means on an individual basis, but that also means that, that's the second one. My first one is you're either over position sized on an individual basis, individual trade basis, or because you're trying to make a lot of money on those individual trades. That's usually why we over position size. Or number two, you're way overloaded on one side of the market, right? In this case, you would be overloaded on the bullish side, which means number three that we're getting in too late, like we're backing up the truck too late in the cycle, and not, which is fine if the market stays bullish, but for all the things I've shown you lately, the market's very mature. It's very mature. It's very extreme in its sentiment, which means that it doesn't mean that we're going to tank, right? It doesn't mean that we're going to automatically just fall off a cliff here. That's not what we're talking about. But it does mean there's a good chance, there's a higher probability of that happening than normal, right? So, no, well, today is one day, but remember, that MNQ is just for the negative delta. It's for a day like today. And if we get another day like today, it's 4 days like this. It's 4 days because I feel like the market's very extreme in its sentiment. So I'm more than willing to make bullish trades, but only if I have something on the other side of the market where I don't have a time frame on it, where I can listen, because I hardly expect the market to take off like a rocket from here, not with extreme sentiment, right? So my risk reward on that NMQ, like, do I have a lot of risk on that? No, because I don't expect the market to take off. For me, the risk on that MNQ trade, for those who don't know, it's my hedge trade. This one right here, it's all my bearish deltas I have, pretty much most, if not all of the bearish deltas I have in my portfolio. So it's a short futures contract on the NASDAQ 100, and it's a micro contract. So my risk on that trade is that the market goes up a lot. And do I think the market's going to go up a lot? Do I think the market's going to go up? Very much. Like, it's all obviously on a bullish trend. So, and even with the pullback today, even with the pullback today, so far, and which is, still not that big of a deal. I mean, we're flirting with the 8-day moving average. So, like, we're hardly tanking here. So when I don't feel like I need those negative deltas anymore, Dennis, when I don't feel like we need those negative deltas. So if we get a nice little pullback to the 30-day, maybe to the 200-day, but once we get an intermediate pullback here, because I didn't feel like we got enough of one there, so I was worried about getting a new bullish run because we had such a big one here and we didn't exhale enough. So I was worried that a new inhale would lead to an even bigger exhale. So that's why I kept it. I didn't trust this new inhale, not after such a shallow exhale, if that makes sense. So I'll get out of it when I don't feel like we need it. When I feel like I've had enough of an exhale that we're okay. I'm okay without it now. And we come up off of a new low point and we're ready to go. I should have pulled this up. I wasn't thinking about it in my prep today. But I showed you in the past that the stock's above the 200-day moving average, right? And obviously we're at the 90% mark. So we're very extreme in that sentiment indicator. But if you remember, I apologize, it would take me a second to look it up, but if you remember the 200-day moving average of that index, so the index is the number of stocks trading above their 200-day moving average in the S&P. So the 200-day moving average of that index is only down to like 50% because we pulled back so much here and we just barely got up. So the 200-day moving average of that index is telling me we still got a good upward potential. Like in the next year or two, I still think we're going to be very bullish. But the fact that we're currently, that we're currently that far away from that 200-day moving average, because we're at the 90% mark, means in the very short term, we're very overbought. I don't mind being up in the 80s and 90s when the 200-day moving average is up in the 80s and the 90s, because that means we got a good, solid bull market, right? We've got a good footing below us, right? But if we are, if the 200-day moving average is at 50% and we're currently at 90, then we don't have good footing below us. That's why I still have the MNQs. And then once we do pull back, once that index, and once we get like a good exhale and we start to bounce, then you'll see me take off that MNQ. At least you'll see me, when I feel like I don't need the negative deltas anymore, then you'll see me take off the MNQ. This whole time I felt like I needed it. Because, again, what's my risk on those short deltas? My risk is the market goes up, right? Which obviously we have an upward market. What's the biggest risk? Is the market goes up a lot. I am not worried about the market going up a lot right now. I'm just not, right? The sentiment indicators are too extreme for the market to go up a lot in the short term, right? So my risk is a lot lower. And what's my reward? Well, my reward is, as we saw before, I mean, we're pretty far up above here. Let me pull this up. Bring up two of them. One of them I'm going to do with the price compared to the 50-day moving average. Simple. And then one of them, the other one, I'm going to do price going up, how far up above the 200-day. This is so annoying to put those numbers in. Okay, so we got it, 50 and 200. Simple moving average. Okay, so when you go over the last, like, 5 years, you know, we are in the 82nd percentile of the market being above the 50-day moving average. So we're 4%. That's a pretty high figure. If you notice, we are currently at 3.98. So if I were to put add a drawing and do horizontal and do it at 3.98, and let me put that to a small width. Okay, that's where we're at now there, and then this one is at, where is it at? 11.5. 11.5 now. So this is where we're at. And I guess I could use what's the clearances chart on this, but this to kind of give you an idea here really quick. Let me get rid of that one. Okay, so there's where we're at on the 50-day moving average. So you can see we're relatively far up above it. Wouldn't you say, looking across to the left? The blue line, blue line's our current level. We're pretty decently above the 50-day moving average, right? And we're in the 82nd percentile over the last 5 years. We are also in the 90th percentile of being far above the 200-day moving average, which you can see again. You know, we're pretty far above the 200-day moving average. We've been there at this level or higher a couple of times this year. Both times were kind of parabolic moves on the NASDAQ, or excuse me, on the NASDAQ here, not so much there, but the NASDAQ, and we got that cluster. There's your pre-COVID levels above the 200. Way over here in January of 18, we went parabolic, and we got that far above the 200-day moving average. So you could say we're pretty decently far above these moving averages. Once we get back down towards them, and I don't think we have to go below them, maybe the 50, we might touch below it a little bit on the intermediate pullback, but we don't have to go below the 200. We might flirt a little bit. You can see during bull markets, we don't go very much. We test the 200, but we don't necessarily go below it, right, until we get more of a, of a death cross or something like these. But we can certainly test the 200-day moving average and still be in a bull market, which I think we're in. So once we do that, and I think we still have the potential for that to happen, right? I still think we have the potential for that to happen. Once we do that, then and we bounce off of it, then I won't need those negative deltas anymore. I feel much better about any new bullish market. I did not feel very good about this new bullish intermediate run, as you've heard me talk about. I haven't felt very good about it. And I don't even think necessarily that we're necessarily over with it yet. Like, we're just today is not like the beginning of a big sell-off. Today is just, we're just testing the 8-day moving average. I mean, break the 17-day moving average, now we're getting somewhere. Now we're worried about especially if we stay below it. Like, we can test it and still bounce. But if we break it and stay below it, now we're looking at an intermediate decline, right? Like over here, got below it and we stayed below it. And that started, we stayed below it for a couple of days. That started our intermediate decline. We are testing the 8-day. So we very well could bounce right off of this. In fact, I would venture to guess maybe, haven't looked yet, but yeah, that's a bullish intermediate confirmation signal right there. Oversold momentum line, but not too oversold. Near-term line below 50, which makes sense. I mean, it was above 50 for a normal time frame. So it's pulled back below 50. And we got as strong as an intermediate posture as you could possibly have. We're at the 97th percentile. So now granted, it's an engulfing pattern, and it's a bearish day, and it could lead to more, but it could also bounce right off of this. I mean, that's a bullish signal. We can stay above the 8-day. We can stay bullish. I mean, I hardly think that today's the day that's starting this big sell-off. But I feel like something like that I feel like the odds of it really taking off hugely to the upside is lower than the odds of it pulling back down to whatever level, right? And if I were to now take this off, remove that drawing, and now, because I don't need this one anymore, I've got a good intermediate run here, right? So, I mean, this intermediate run started, we're a month into this intermediate run, so that's a pretty decent intermediate run here. So I can draw lines on this, and you can see, like, yeah, who brought this? George brought this up, well within the 23% retracement of this rally, this intermediate rally that we're on, well within it. Noise. It's noise. Carl said that too. It's noise. So it's, you know, you notice, a lot of you have noticed, and some of you who are new, I don't get worked up about things. I just don't. I don't get worked up about big moves, and today I'm not getting worked up. Now, it's nice, especially nice for our inventory trading, right? So if you go to December inventory, which is getting really close to being done with, if you take a look, and we do have to pay attention on these in-the-money calls, we do have to pay attention to dividend risk. So, like, this doesn't meet my rule yet to get out, and I think that we will get, you know, once it does get closer, we can get a sign on this for the dividend. So we have to be very cognizant. As of right now, the dividend's usually about $1.33, and it's costing me $1.83 to get that. So right now, I'm okay. I don't get worked up with basketball coaching either. I'm a process coach, not an outcome coach. If that makes sense, Michael. My thought is, if you have a good process, the wins just take care of themselves, right? And then if you don't, then you just learn from it. But I'm a process guy, not a outcome guy. So yeah. So right now it's paying $1.70. It costs $1.77 to get into to get that. No. So let's see. Brandon chatted to me here. This did meet the 10% rule earlier, and I must have missed it. This did meet the 10% rule earlier, and we closed out perfectly okay to close out at that point. I mean, 357 is way down here, so it's still pretty decent chance, pretty unlikely we're going to get back to in the money, right? So nothing wrong with you keeping that rule. I just missed it, so. And so, like, more than likely, I'm going to end up closing that. More than likely. It's in December, Bill. Bill asks when the dividend is. They pay out quarterly, obviously, so it's March, June, September, December. So December, we're in December. And it's the ex-dividend date is always the Friday, for SPY at least, is always the Friday of expiration. So that means that if anything's in the money on Thursday, then they'll be closed out. Yeah, so this Friday. Is it this Friday? No, it should be next Friday. I think it would be next Friday. I could be wrong, but I think it's next Friday, the 18th. It's always a Friday of expiration, always has been. So if you have anything that's in the money by Thursday, then you're going to get assigned if there's anything. So, so right now, for me to get a sign on this, it costs $1.89 to buy this put, which when the cost of this put gets below the dividend payment, then you're going to get assigned pretty much automatically, right? So it's not a concern right now. It's not a concern for this. The reason being that if the market maker can create a synthetic call position with the stock and a long put, right? So they can create a synthetic call position with the stock itself 100 deltas and the long put, which would bring, minus 24 deltas. So that's a synthetic long call position, but with the shares. So, because you keep in mind that if I am short this contract, who is long that contract? If I am short that contract, who is long that contract? Yeah, the market maker. The market maker is long, unless he or she, unless they turned around and traded it to somebody else, right? So, but the market maker is always on the other side of every trade we ever make. So if they have if I'm short, that means there's a long call, so they can recreate a synthetic long call with 100 shares of the stock and a long put to get that dividend, because you have to have the shares to get the dividend. So if the cost of the put is cheaper than the dividend, then it's free money. Whatever the difference between the dividend and the long, because you have to have the long put to create the synthetic long call. So if the cost of buying the put is cheaper than the cost of getting the dividend, it's free money for the market maker. If you're still in the money but somebody's got to be on that short contract's got to be out there still. So if it's out there, they will convert their long call into a synthetic long call, and they can do that, right? Because if they have the long call, they can exercise their long call and buy the shares of the stock. So they buy the shares of the stock, they buy the put at the same strike. Now they have a synthetic long call at the same strike, and they get free money. They get the dividend payment now, and with a really cheap put to create the long call. And then they just close out their long call when they're done. Once they get their free money, they close out their long call and they're done. Okay, and you can't do anything with a short call anymore, because once they assign it to get the dividend, there, then you're done. You're done with the trade, because who are they going to get those 100 shares from? They're going to get it from me. So that's how it works. That's something that we have to pay attention to this month. We don't have to pay attention to it in November. We don't have to pay attention to it depending upon the stock or in October, but we do have to pay attention to it in the inventory class, because we use the ETFs here in March, June, September, and November. Okay, we'll get to IWM in a second. And I don't believe, I'll have to check their ex-dividend date. But we don't have to do anything there yet. And we also have some calendars, which we are very close on. In fact, we have actually touched the 366 today, and we have also touched the 368 today. So I'm actually going to close both of those those calendars, right? 366 and 368. So let's go ahead and close, because we've touched them and we're inside of 10 days now. So let's close that one out, buying those two contracts, and then let's go to January. And sell these, and for 2, and that gives me I can get $438 back for doing that. And we will also do the same thing with the 368s. Sell those 2. Come over here. And buy these 2. We do those, and close it out. Mike says, why do we sell them when there's so much extrinsic value left to make to expiration? Because when they're at the money, then we are maximizing the extrinsic value in the January, right? So we can stay in them when we're inside of 10 days. We can stay in them for whatever time I have left to get that extrinsic value out of it in the December. But as this goes down to 0, then the Januaries will go down too, right? And the Januaries not only go down just a little bit in the next 9 days, but they'll go down a lot if we move away from being at the money. See how, especially if we go up, you see how it goes from $8.97 down to $5 or to $6 over here. So we can lose extrinsic value on the Januaries if we get out, if it moves on us in either direction. in the next 9 days. So because that's when the trade finishes, right, in the next 9 days. So that's the reason why, Mike, because I am maximizing the amount of extrinsic value that I have in the Januaries, with the idea that I've also closed out quite a bit of. I mean, we made money on those calendars. We actually did pretty well on those calendars. When we bought into them, they didn't cost $430, $480, right? The rule on calendars, in fact, the rule on calendars to wait until the extrinsic value falls is the worst case scenario, right? In fact, let's take a look at where the rest of my calendars are for SPY. Let's go to December inventory here. We got 360, and I'm looking at my Januaries. That's how I can tell. 360 and 344. So let's go up here. 360 is probably not. Yeah, so that's not. I still can touch 360 if we continue pulling back. I can still touch 360. And what did I say, 345? 344. That one's not quite. So that rule of closing out at 10% is for the worst case scenario. The best case scenario is touching the strike within 10 days to expiration, because that maximizes the extrinsic value in the back month, and that's the one I'm selling to get out of the trade. So I want to sell it at the highest price possible. I don't want to sell it at the highest price possible there. If you recall, when we got into this, we were at the 30 delta. So if I were going to do a January calendar today, all right, so when we get into this, I'm at the 30 delta, so that's way over here. So you can see the extrinsic value is $6.14 now at the 30 delta if I were doing one today, and the at the money is at $12.80. So yes, these numbers are all going to go down as time passes. Not as fast, because you can see I'm still at 37 days here. But all those numbers are going to go down. The $12 on the January is at $8.50 now, but it goes down a lot more out of the money than it does at the money. At the money, it stays up quite a bit. So when you're at the money, you are maximizing the extrinsic value that I can sell it for later. So even though I started here, I can end up at a higher number than that. I can end up at a higher number than 618 by the time all is said and done. And if you notice, so I just did December, and December, the at the money is what, $4? $4.50 is December. And right now, if I were to do a January call option for the 30 delta, you can see, I don't lose very much money there, do I? Right? I mean, I don't make very much. It doesn't lose very much extrinsic value. I don't make very much money on if 376, if we touch 376 within 10 days of expiration. I'll make a little bit. We're down to 450 right now in December. So I'll make a little bit on that, but I'll make more money on this going up to whatever number it's at by the time I close it out. That's why I want to get out of it when the strike price touches within 10 days, is to maximize this number. Whatever that goes up to, I want to maximize that number. Does that make sense? I know Mike asked, but does that make sense for everybody? That's how calendars work. In the best case scenario, that's how calendars work. In the worst case scenario, we just keep going further and further away from the strike, right? In the worst case scenario, we just keep losing extrinsic value. If we're way in the money, you can see I won't have very much left. If we're way out of the money, I won't have very much left either. So that's the worst case scenario. So that's when we close it out. Yep, whenever there's a touch, within 10 days. Within 10 days. Obviously, if you're a lot closer to, to the expiration date, if you're a lot closer, it's even that much better because then you will have a smaller number there. It will go down in the back month too, but not very much. And this will go down a lot. But you're running the risk of us moving away from the strike within those 7 days. And the more it moves away from the strike, the more I will not maximize the back month. So that's the risk. Once, if you wait, like right now we're 9 days away. So I thought, well, if I wait a few more days, then I can make that much more money on this. Well, that's the reward. The risk is we move away from the strike in those next 4 or 5 days, and now I'm not maximizing that January, so I don't make, and I could actually lose. I could actually get out with a smaller gain on the calendar by waiting 4 or 5 more days. All right, so that's how that works. So I still have 360. Do I still have the 360? Is that a... Yeah, 360. I still have the 360, and that's still got a pretty decent chance. So I'm going to leave. I mean, they both do. The 344, the 344 most likely is not going to be touched. So I'm going to eventually close that one out. In fact, I could probably close it out right now because, again, the equivalent call option, the extrinsic value is less than 10%. 237 is the 10%. We're well below that. So there's a very unlikely chance we're going to touch 344. In fact, I think we'll just go ahead and probability of touching is only 15%. I think it's very unlikely we're going to hit 344, and which is way outside the 4-week range by the time. So I'd say we go ahead and close this one out anyway. You know what? I'm going to not do that. What am I thinking? Let me tell you why. It's the opposite of what we just talked about. So I could avoid, rules, exactly. And here's why I'm going to wait. It's the opposite of what we just talked about. So if I get out now, I can avoid losing 54 cents. Well, I made 54 cents, but I can avoid losing whatever, what was it, 344? I could avoid losing whatever that will turn into, 315, whatever that could, because I have to sell this. So I can avoid losing whatever it can turn into. Okay? Yep, 10 cents or less. But the VIX goes up, then this is going to go up. This number is going to go up. So I can sell it for more. Remember, I'm going to sell this to close it out. So like Carl just said, if the VIX goes up, that number is going to go up. And VIX going up will impact this one more than December. The reason why is because there's more time value left on an absolute basis in January than there is in December. Remember, volatility only impacts time value. If there's not very much time value left because you're close to expiration, volatility won't impact it very much. So the VIX will actually impact this one a lot more than the December. So that number will go up if the VIX goes up. December's already lost most of its value, so it doesn't have very much left to lose when it's that far out of the money, 54 cents. And the Vega is really low right now. Here, let me show you. Let me show you what I'm talking about there. So let's go here to Vega. So Vega is at 32 cents. Here, 32 cents out of 316. So 1 point volatility, a 1 point change in volatility will have a 10% impact on the price for January. Okay. If I go to December, 10%. If I go to December, a 1 point move, Vega, 8 cents. A 1 point move in volatility will have still 14%. So actually there's still enough time that it can impact this one more. But that's going to eventually really drop off because it's just not going to have very much of an impact there. Okay? So it's still a few more days that we can still impact it more in December, but just barely more. Eventually there won't be very much extrinsic value left and it just won't be able to impact anything. Okay? All right. So that's volatility. So I mentioned, why do I want to not close this out now, even though there's a very, very low chance we're going to touch 344? And here's the reason why. That doesn't matter to me. If I wait, I'll make 53 cents, right? At the expense of waiting and losing more than 53 cents there, which is unlikely because time decay is a lot lower here. So that's the problem, right? That's the problem. The exact opposite of what I told you before about getting out once we touch the strike plays out here. If I get out now, then I'm 325. If the market goes, if this becomes more at the money, then this number can go up. See? If in the next 9 days we do get closer to 344, that number will go up. And if volatility goes up, that number will go up too. And considering that it's so far out of the money, the likelihood of it going further out of the money is a lot less than the likelihood of getting closer to being at the money. Because remember, we started off at a 30 delta on this in December. We started off at a 30 delta on this in December. It's at a 9, let's see, where's it at now? It's at an 8 delta now. So the odds of this going further out of the money to an extreme is a lot less than the odds of it getting closer to being at the money because it's already gone so far out, so far from a 30 delta down to an 8. So I'm going to hold off on that and just make that 60 cents with the idea that no matter what the market does, I'm going to make 60 cents here, right? No matter what the market does in the next 9 days, I'm going to make 60 cents on this. The question is going to be how much I make or lose on this. And very unlikely I'll lose more than 60 cents on this by waiting. The market would have to go further out of the money, and that's always a possibility because nothing's 100%, nothing's 0%. So that's always a possibility, but it's more likely that this number will actually go up between now and December expiration. So I can maximize that number by waiting, just like I can maximize this number by closing out now on these two. I can maximize this number by closing out now. In the best case scenario, I can maximize this number by waiting in the worst case scenario. Does that make sense, everybody? Either way, I'm trying to maximize this back on a calendar, mind you. I'm trying to maximize how much I sell this for in the back month, the extrinsic value. I'm trying to maximize how much I sell that for in the back month. Because when you close out a calendar, you're going to close out the January options, the back month. You're going to close out, you're going to sell those options. Because typically on those vertical spreads in the December, I'm buying and selling there, but I'm buying and selling the same expiration date. Here, because I have longer expiration, I need to maximize this number in either case. So that's kind of the idea there. And there's always risk, and like I said, the risk is it keeps going, but the odds of that are lower. Okay. So we'll keep that one going. We'll keep that 344 going. Let's see if I need to close any of these out. These all still have extrinsic. The furthest out of the money all still have a few pennies left of extrinsic value. So we'll leave those on until they bleed out. They're not done. And these aren't done either. They still have plenty of extrinsic value left as well. So we'll leave those on. And this one is close to being in the money, and probably was in the money here before today when we were at 371. So this was in the money, and now it's not. So we'll just keep going on SPY. Let's now take a look at IWM. Anything over here we need to close? I can close this one out. So it doesn't have anything left in it, December expiration. This one still has a few pennies left, so we'll just leave that for another day or two. Over here, 62 cents is the magic number. That's 10%. If I'm in the money, I need to close this out eventually. The ex-dividend date looks like it was after expiration in September. Because remember, the SPY was at the 18th. This is January or September. So we don't have the same issue we don't have the same issue with IWM as we do with SPY. Okay. All right. So with that being said, I'm not at 10%, so I can leave all these on. 41 cents there, just at 215. I can leave all these in. There's still a decent chance that we can come down to, what was it? $1.84. 184 is right in there. So still a pretty decent chance we can come down to the point of control. So I'll leave those on. The options market is saying there's a pretty decent chance, so we'll leave those on. Okay, let's look at the Qs. That's been a big mover here lately. Still extrinsic value left in these out of the monies, and these are all out of the money, and there's still extrinsic value left in those. So we'll let those keep working, making us some money. On the Decembers, it is still got extrinsic value in both cases. Bonds, we have some in bonds, all out of the money with extrinsic value left, so nothing to do there. And then gold. So all out of the money, still got extrinsic value here, and still got extrinsic value there. So we are just going to let this inventory keep making us money, right? So this is my December inventory right here. So if we stayed right at the current levels, which means that the IWMs are out of the money, or in the money, I'd have to close them out. If we stayed right at the current levels, then I will make about $1,000 of inventory. If we pull back more to where those IWMs are now out of the money and they expire worthless, if we pull back to 353, which would be down to here, even if we pull back this to 360, if we pull back to 360, then I can go from being down $200 on current positions. This is on current positions, mind you. Remember, we just closed out one in the out of the money trade. But I would go from a loss of $200 to a gain of $2,600. So I would make about $2,200, $2,400 of extrinsic value. Some will be in the money, some won't. So that's only to 360 if we get down here by expiration and fill in that gap. So we're still okay to let this keep working. And like Bill said to me here, whoops, that today's a good day. Volatility is up today, right? Volatility, you can see on an intraday basis, volatility is up today. So we can take advantage of it being up today. And it's up a pretty good amount, right? If you look at the VIX on this chart, so if you look at the VIX here, then that's a pretty decent update on the VIX. Obviously, it kind of skews. These numbers are skewed because it's 1, 2, and 3%, and this is way up. But a good day to add some inventory on this. So I'm going to come over here, and we're relatively high as it is. Put out to January, and let's go. So here's an issue. Is we do have some contracts already at the 20 deltas. So let's come over here. We don't here, so that's good. Should probably always check the call side first. It's the hardest one to get movement on the 20 deltas. But I'm actually, because I don't have anything on SPY, I'm actually going to add a couple of these and hit confirm and send and put it into January inventory. And then let's see what QQQ looks like. And let me see where I'm at with January really quick. Make sure I'm not overloading here. I'm only at 4,300, so 6,250 is the most I want to have, and the green number in that box. That's the most I want to have until I'm done with December. That's the most I want to have, so I still got some room to add. So I'm going to come over. Was I beta weighted? Yes. Okay. So I'm going to come to QQQ. And see if I can do, I can do something there on the put side. Let me just make sure on the call side that's the case. And I can. There's enough movement there that I can spread out my risk a little bit. I'll add a couple of these for January. Let's see what that does to my beta weighted. See what that does. So simulated trades, and I'm going to analyze that. So now that's my only simulated trade. So with that contract going through, I'm still okay. I'm only at 4,600 now. I still got plenty of room to add within the next week. And then my Vega is 119. So I'm a little high in the Vega, on the Vega there. I've got quite a bit of negative deltas for, but 1% is 46. So I'm more than 2.5% there. So I'm pretty high on my volatilities. So I'm going to come actually with SPY, because SPY, the VIX is high today, and we did take advantage of that. It's still relatively low here. So there's, like if we move through this zone and up into bearish territory on any kind of intermediate pullback, it is still relatively low, right? So it wouldn't, even though it is high today, I don't like my Vega being as high as it is. I'm just going to add a little something, just a little calendar, because I don't have any, just to kind of offset that a little bit. So I'm going to sell the 30 delta, and I'm going to sell over here at the 30 delta for the call. So I'm going to sell both those puts. I'm going to come over here to February, and I'm going to, 353, and I'm going to come over here to 376. So that will add about $700. So I've got room, so I'm just going to throw that on, confirm and send into January inventory. Throw that in there to help offset. Let me just make sure. Okay, let me analyze that too. So there's the Qs. The Qs just went through, so I'll take the Qs off. The Qs just went through, and then there's my double diagonal. So yeah, so now I bring it down to 80 on $5,300. So 1% 53. So now I'm below 2% on my Vega. So I feel really good. Yes, this is an advanced options class, Angela, so you're right on. This is an advanced options class, and there is something in the Ask the Assistance forum that Clarence has posted with some rules of what we do. You'll find, once you do get the rules down, you'll find that it's very simplistic. In fact, I would have colleagues that tell me I'm a little too simplistic in my rules. So you'll find that it's very, very easy. And the reason why is I like to be consistent and very easy. A lot of the time it takes for me in the class here is basically used to tell you why I'm doing what I do, but the actual rules themselves are pretty straightforward. In fact, I could probably do this trading room. in probably about 10-15 minutes. And there's that one. That one's going through. I could probably do with my trading room if I just like executed trades, I could do it in about 10-15 minutes and just be done. But I don't, obviously, because it's hour-long trading room. So I spend the time to kind of explain why we follow the rules that we do, and take a look at current markets and all that. The Ask the Assistance forum right now, Clarence has put together a plan that's posted there in the Ask the Assistance forum. It might actually be in the advanced options, in the options inventory trading forum. It might be in both spots. So that's where it's at. Okay? Yes, and only a few percent, a very small percentage of our portfolio is in this. 25% of our active trading portfolio, which is 10% of our total trading portfolio. So this is basically a way to add some positive theta to your portfolio. That's the whole point of this. See how my whole active trading has 300 deltas of positive theta, my whole active trading? Well, my December has 114 of them still, and my January has 37. So it's, a good chunk of about half is coming from a very small portion of my active trading portfolio. Yes, in the forums. in the forums so when you go to our website, here, let me find it. We got a bazillion tabs put up here. So if you go to our website, let's give it a second to load. My computer's running really slow right now. Okay, so you mouse over the trading rooms here. There's usually an arrow there. For some odd reason, they're not showing. When you mouse over trading rooms, you go down the class forums and then go to either the options inventory trading right there, or you can go to our forums here, community forums, and go to the Ask the Assistants forum right there. In fact, I'm going to put that Ask the Assistants forum into here too. So I'm going to put that up there so you can see that. That's a premium forum for this is a forum just for our advanced trading. Okay. All right. Well, with that being said, thank you all very, very much for coming on. I appreciate your time here today. We do have our Market Outlook live here at the bottom of the hour. And I'm going to probably go about 5 minutes, 10 minutes. I got to run after that for a road trip, and then we'll do the Market Outlook when I get back later tonight. So stay tuned for that, and then we'll see everybody in class next time. All right. Thanks, everybody.